Hi everyone, so today we'll be covering Celsius Holdings. The earnings came out for Q2 2025, August 7th, so let's get right into them because they were quite good. So we're going to take a look at how everything performed. And as you could see here, EPS came at 47 cents, beating analysts that had estimates at 23 cents. Revenue went up 84% year over year. Incredible. They did have a new acquisition called Alani Nu, so it did contribute to the quarter's revenue. Analysts expect Celsius earnings to grow by 21% next year, with the EPS projected to grow 89 cents to $1.08. The company's revenues are also forecast to grow at a strong rate, so that's great too. They're looking at more international expansion into the UK, Ireland, France, Australia, New Zealand, Netherlands. Also good. And keep in mind that they do have a little bit of tariff problems, but it looks like overall it didn't affect them too much either. If we check the guidance, next quarter for Q3 2025, it looks like the EPS estimate is going to be 21 cents with a range of 18 cents to 24 cents. Full year is 83 cents with a range of 76 cents to 91 cents. And there's strong earnings growth in the coming years. For 2026, the average growth is $1.18 for 2027. Another source suggests EPS growth of 30% over the next 3 years. So overall, looks really good. I would say they are increasing every quarter and every year. So great, everything looks pretty good. They have had quite a falling off from the stock getting crushed, and now it looks like they recovered somewhat, not fully, but somewhat. Next I'm going to show is Simply Wall Street. And Simply Wall Street's going to have a bit of a different picture here. So we have free cash flow 210 million, but then by December 30th of 2027, end of 2027, 456 million. So it's a double, which is good. Pretty much in line with these high growth companies, which makes sense. If we check the financial health of the company, which I'm going to show in a second, the financial health of the company, I don't know what's going on here exactly because the debt is increasing here, and the debt's now higher because of the more than the cash, and I'm guessing it's because of the recent acquisition of what I just mentioned before, and I think that's the reason the debt has increased and the cash has gone down. So it's probably to do something with the financing, but you should be aware because keep in mind there is no debt and a lot of cash and equity, and now there is debt. Debt's higher than the cash, so you have to keep in mind that. If we check MyDCF is going to say that it's 72% undervalued. This is based on historical growth. However, if we check Wall Street forecast, which is going to be a little bit of a different story, it's going to become 52% overvalued. So I would probably go by historical growth, but then again, I don't think it's going to be 72% undervalued, just based on everything that I've seen. If we check lastly Tipranks, which I'm going to load up in a second, Tipranks is going to be strong buy, 14 buys, 2 holds, 1 sell. And let me reload that again so everyone sees it. And yeah, we have average of like 57 bucks a share. So I think right now, based on everything, because it's a low of like about 40s and like 45 or something like that, 42, and right now it's at 54 bucks a share, I would probably wait for some kind of sell-off and try to get it at a lower price than it is now. But Celsius does look like a very promising recovery in a good recovery time period, which it's had struggled with the past year or so. All right, thank you, everyone.